Hello, this is Dr. Bhushan Shanbhag. Welcome to this series, Trading the Gaps. Today we are going to see the third video. So it's part C. Gap up and gap down opening. Last video we have seen what is partial bull gap, full bull gap, partial bear gap, full bear gap. Now, whenever that Nifty is going to open, gap up or gap down is almost always certain. Okay. So this is what we are going to study. After a gap out or after a gap down, how does Nifty move? Okay. So opening may be gap up or it may be gap down. And gaps may be partial or gaps may be full. We know that. So we have come across the four different types of gaps. Right? Partial bull gap, full bull gap, partial bear gap, full bear gap. I'm not talking of the filled gaps as of now. Filled gap is filled during the course of the day. At the open, the gap is existing. And it has to be one of these four. Right? So whatever it is there, filled and unfilled happens afterwards. Correct? So how many times the gap is formed? The question comes, if I talk of the current market situation, almost every day, the gaps are observed on the charts at the opening. If you see since 2011, percentage-wise, more than 99% of times, there has been some gap. All right? Some gap is always there. The question arises, are these gaps significant? Are these gaps important? Do they carry any importance in our decision making? Also, if the gap is filled or not filled within the day, is it important? Okay. Suppose you have kept a naked position overnight. You have bought naked calls or you have bought naked puts or you have a naked position in futures. You should know how Nifty is likely to move in the course of time within the next day. So let us consider I have a short position open in futures, Nifty futures. Now day is ending. I don't know tomorrow what will happen. Will the fall continue or will there be a bounce? Will my position add to the profit or may I lose the profit? What is likely to happen? Many traders keep these type of positions open overnight. All right. The question arises, what is the probability of profit in leaving the positions open, naked positions open? So let us see the details about the gap fault. Okay. And what types of gaps and what are the implications of open position which you have kept overnight. If you see the data from 2011, okay, the markets have opened with a gap up or gap down. I've already told you almost every day. Almost every day there is a gap. Out of this, if you see the full period from 2011, 2/3 number of times there is a gap up. Market opens higher than yesterday's close. Okay. 1/3 number of times it opens with a gap down. All right, I told you it's actually more than 99%. There is a gap. Partial, at least partial gap is always there. Okay, but as I said, 2/3 number of times bull, 1/3 number of times bearish gap. But remember, this is from 2011 data. Naturally, there is a tendency of market to open higher than yesterday's close. The question arises, okay, fine, but is this 12 years of data? This is 2023 when I'm recording this video. So is this data having any relevance? So I also checked for last 5 years since 2017. And then what I found is now it is still dominance is towards a bullish gap, but it is no longer that high, 66%. It's not that much. But remember, still, if you have a short position overnight, more than 50% chances, majority of cases, tomorrow morning market is going to open up. Naturally, naked shorts, unless and until there is a compelling reason to do so, I would not keep open any day in Nifty. Neither future shorts or not bought puts. Even sold calls, if they are at the money, I will not leave them open or in the money. Out of the money, maybe they may be left open. All right. So preliminary we can conclude that buying naked puts or keeping short futures open is less likely to be profitable than buying naked calls. Buying, on the contrary, buying naked calls, this itself shows that bull gaps are likely to be there, so it may be profitable. Of course, maybe more or maybe less, that is immaterial. But there is definitely a bias towards naked calls being more profitable than naked puts being profitable. Okay? So we should refrain from keeping long naked positions open, not long naked, short naked positions open. Okay? Unless we are quite confident about doing so. And that does not apply in severely bearish situations. That time it just continues because it's not 100% times it opens higher. So what I would say is, if Nifty is falling, at the close you should at least reduce your negative position, and that doesn't mean you should go long in it because it can open gap down. Okay, so if the trend is down, you should be down, but more down or less down, money management principles. So near the close, square off your negative positions, again open next day if there is again sell signal, fresh sell signal. All right. Now, what happens in recent past, I'm going to add, but that would be in the next video, not in this video. So keep watching this whole series. All right, understood? So buying calls is more likely to give you money overnight than buying naked puts. Naked puts are absolutely a no-no in majority of situations. So thank you very much. More in part D of this video.